Something that is crucial for every real estate investor, no matter how many properties you own, is tax strategies. Whether you own one property or a few properties, knowing the tax advantages that are available to you can save your portfolio thousands of dollars. I'm Hannah Escher. I'm a rookie investor with 2 properties, and today I am so excited to be joined by Amanda Hahn, a CPA who specializes in real estate tax strategies. Amanda, it is so lovely to have you here with us today. And before we get into all the questions, I'd just love to know a little bit more about you, how you got into this, and why you're passionate about real estate tax strategies in general.
Thank you so much for having me, Hannah. I'm super excited to be here back on the BiggerPockets YouTube channel. I mean, a little bit about me. Besides being a CPA and tax advisor, I am also a real estate investor myself. So just like everyone else, there was a time when I myself was a rookie investor. So I completely understand some of the struggles that investors have getting started and the first 1 or 2 rental properties. My firm is called Keystone CPA, and what we specialize in is working with real estate investors nationwide on how to use real estate to save on taxes. I think everyone hears about all the tax benefits of investing in real estate, but what I find is that most investors, whether they're newbie or, even really seasoned investors, have a hard time understanding exactly how to use the tax law to their benefit. And that is fortunately, one of the passions of mine is really to help simplify tax planning. So it's not so scary, it's not so boring, and it really becomes an easy way for us to build wealth.
Well, thank you so much for sharing a little bit about yourself. And that is fabulous that you are also a real estate investor, because you can also speak from your personal experience then, which I know as a rookie investor myself is so helpful. So as we get into this, can we just start with what are some of the primary benefits of owning a home? What does that look like if you own 1 property or 2 properties or multiple? What are some of just those basic benefits that home ownership provides?
Well, I mean, when we talk about real estate investing, one of the main benefits is that as a real estate investor, we actually become a business owner in the eyes of the IRS. And I put that in quotation marks because we all hear, the tax law favors business owners, right? Business owners get to take deductions and write off different things. And so really important to understand that as an investor, we're in the business of rental real estate, whether it's rental, wholesale, flipping, right? We're in a real estate business. And so as a business owner, now for the first time, we can start to take tax deductions against the income we're generating versus maybe for some of our newbies in the past, if all we had was W-2 income, we know we're very limited in terms of what we can write off. And so that's where the fun begins, is now we're a business owner and we can start to take advantage of some of these tax deductions.
So when you're referring to tax deductions, what could be included in that category?
I think it's probably one of the most common questions I get asked all the time, Hannah. So I'm glad you are starting out with that one. People tend to think like, okay, that all sounds great, but what exactly can I write off? And so the list of things we can write off is actually pretty endless. In order for something to be tax deductible, 2 things must be true. Okay, 1, the expense has to be ordinary, meaning like I'm a ordinary, landlord or flipper. This is something that is normal for an actual investor to incur. And then the second component is that it's necessary. So was it necessary for me to have this expense in order to generate the income? And so a really good tip I have for investors is before you spend money on something, ask yourself, is this something that's ordinary and necessary as a real estate investor? And if so, then I want to make sure I'm tracking those expenses. I think the reality is there are going to be times when you spend money and you're just not sure what the answer is. Like, maybe I'm going to Florida to look at real estate, but also going to hang out with some of my girlfriends. Is that ordinary and necessary for my real estate? And that's a really great opportunity for you to talk with your tax advisor, right? Because that's what your tax advisor is there to do. So maybe normally if I'm going on a girls' trip, it's not tax deductible, but how can I make it tax deductible? What are some of the things I can do beforehand to make it a business tax deduction?
One more question I have along these deduction categories is, can you take the same type of deductions if you are, reporting this income just in your personal taxes versus if you're an LLC or a separate entity or something like that? Is there an advantage to, becoming a separate entity, or, is this something that can just be reported on your personal tax returns and you can have the same benefit?
I think that's a common misconception I hear from investors a lot. And earlier I said, hey, now we're in the business, right, of investing in real estate, and people tend to associate that with legal entity. And so people often say, oh, I love it. I really wish I would have had an entity so I can write off my BPCon tickets or something. But the reality is you don't have to have a legal entity. We can write off most, if not all, of the same expenses, even if you're an investor who owns a rental in your personal name. Or maybe you paid for BiggerPockets conference tickets with your personal account, okay? So the IRS does not require a legal entity in order to make something deductible. All they require is, like I said, ordinary and necessary with respect to your real estate activities. So even for a lot of our newbie investors, don't get caught up in lack of having legal entities. Just make sure that you can substantiate that those are business expenses relating to your real estate. Having said that, it's not to say you shouldn't have an entity like an LLC. Those are definitely really powerful in terms of asset protection. So if there's a potential lawsuit, we will not get sued. Your attorney will typically recommend having an LLC for that purpose. But when it comes to deductions, it's very simple. As long as you have real estate income, those expenses are tax deductible against that income.
That is so helpful because you're right. I mean, I know myself as a rookie investor, I'm always hearing, well, you should probably have a different entity versus not. So that is so exciting to hear that the benefits can be, for someone who's just, maybe has one or two properties, reports them on their individual tax returns. But let's move on to depreciation. Now, this is a word that's thrown around all the time in real estate investing. At least I hear it all the time and talk about the benefits of depreciation and all of this. Can you explain what depreciation is and how that benefits someone as a real estate investor?
Well, Hannah, we could probably talk 8 hours just about depreciation. I'll try to break it down into kind of what's relevant for newer investors. So, like you said, depreciation is a term that's thrown around a lot. Basically, the easiest way to look at it is it's a paper write-off that we get to take when we own rental real estate. What the IRS says is when you own rental properties, they expect the property to have wear and tear over time. And so because there's wear and tear on the property, you get to take a paper write-off on part of that purchase price of the building over the time. Usually for residential properties, you're writing it off over 27 and a half years, okay? Which means if I bought something for $300,000 of my building, I can write that off over 27 and a half years, little by little. What we love about depreciation, and one of the reasons why it's so powerful as a tax strategy, is that you can take this paper loss regardless of what actually happens in real life. So even if there was no wear and tear, even if the property was actually going up in value, we still get to take this paper write-off year after year, and which is, pretty unique to real estate. Like if we buy stocks, we don't get to depreciate it. Even if the stock prices actually go down, you don't get to depreciate it, And so real estate is just one of those few asset classes where we get to take a loss on something, even though it might be actually going up in value.
Okay, so you're able to take this loss. How does that help offset your tax liability?
Let's say you're a property owner and, with your first rental, you have, let's say, $10,000 of rental income for the year. And if you, even if you maximize all your write-offs, like we're deducting mortgage interest, we're writing out property taxes. If we have a property manager, we're going to write off the management fees we pay them. And then we get to write off, hopefully, some of these smarter deductions like a trip to Florida or going to BPCon. And if after all those wonderful write-offs, we still have taxable income, then the depreciation will also reduce the rental income that we get. And so this is where you hear a lot of investors talk about how they have rental real estate, they get very good cash flow, but on the tax return, it actually shows a loss, right? And so newer investors are kind of sometimes confusing, like, well, you have a loss, that's terrible. But we're talking about a tax loss, right? Including this paper write-off that we get to take. And so that's why it's very, very beneficial. For most of our investors, the goal is to have cash flow, positive rental income, good appreciation of the property going up in value, but also not paying any taxes on all of those gain and income.
Yes. Oh my gosh. Yes. The lower the tax liability, the better, right? So, and I know we're all trying to get there for ourselves. So let me ask you then, does owning one, two, three, four properties make a difference in how this can affect your tax liability? So, for instance, is each property treated separately on your tax documentation, or can owning more be an advantage tax wise to owning less? What are your thoughts on that?
So every property is reported separately on your tax return. So from a record keeping perspective, people always ask like, how should I track my income and expenses? So we always recommend property by property because that's how they have to show up on the tax return. The good news though is if you have income on one and losses on another property, they can actually offset each other. So even though we report each property separately, they do offset each other for purposes of, what is the total true profit. And this is true even if you own real estate in different LLCs. So if I have a couple rentals in one LLC and then maybe I have a couple rentals in another LLC with a partner, let's say, usually they ultimately can offset each other when it comes to income and losses.
So even if, we're starting with one property that's producing income, the more we have, the more they can kind of help even out our situation, whatever that may be. Whether we're trying to have a bigger loss so we can have a lower tax liability, or, we're trying to have the numbers just benefit us better, it's beneficial even as time goes on and we get more properties and more cash flow.
And, I would say too, so far we're talking about using write-offs and depreciation to offset taxes on rental income. For some investors, you can actually use all those benefits to offset W-2 income as well. So for some of our newer investor clients, if your income is between, $100,000 or less, or even $150,000 or less, you can potentially use up to $25,000 of rental losses to offset W-2 income as well. And so for those starting out on the real estate journey, being able to not pay taxes on $25,000 of income could be a game changer. And sometimes that's a down payment on the next rental property.
And I love how, you as a real estate investor yourself are helping us think about these things where we're able to save money somewhere for future investment somewhere else. Is that right?
What I tell people is tax savings is probably the easiest money you can make because you've already made it. You did all that hard work to make it, whether it's through your job or through real estate investing. So it's just taking a little bit of extra effort to make sure you're keeping it.
That is an amazing saying. I should put that on my wall to definitely prioritize tax strategies always. I'm always about how can I pay the least amount in taxes? And now I know, we were going to talk about some of the common mistakes that rookie investors make when it comes to tax strategies. And we touched on a little bit about the legal entities. Is there more in there that you feel like would be good to us to know?
Yeah, it's funny because you just said that, you want to prioritize tax planning, and it's definitely something I see missed from most new investors that we meet. I think a lot of people have kind of a thought in the back of their head, like maybe I'm just not big enough for tax planning. It just sounds very expensive and complicated, right? Like, how many rentals do I need to own before I do tax planning? How much income should I be making before I do tax planning? And the reality of it is that it's not about how much income you make or how many properties you currently own. And it has everything to do with what do you plan to do in real estate? If you're just going to buy one rental and that's kind of it for the next 10 years, then yeah, maybe tax planning is not super important. But if you have a plan to scale, I want to buy a property every year, I want to buy two every year, then there's definitely opportunities to save on taxes with proper planning.
That is so valuable and really an important reminder for all of us rookie investors out there that it's important to be transparent with our professionals we're using, whether that's a real estate professional or tax professional like yourself, to, include everyone in the plans that we do have, so then each person can help us the best of their ability. So, Amanda, thank you so much for joining us today. Is there anything else that you feel would be helpful for our rookie audience to know?
Not everybody starting out has the budget or the ability to hire a good team, whether it's tax or legal, right? And so what you want to do is try to get the best you can afford at the time. And there are a lot of things that you can do really to get started that's very cost effective. My husband and I wrote the tax book published by BiggerPockets called Tax Strategies for the Savvy Real Estate Investor. So you can get that from the BiggerPockets bookstore, where we talk a lot about, what are some of the things you can write off and how do you track those expenses. And, being on watching YouTube channels like this, where you just educate yourself little by little about what are some of the small things that you can really do that can make a big impact in the future when it comes to tax savings.
Thank you so much for your time today, Amanda, and for sharing all of this vital information that every real estate investor can benefit from. And if you are not working with a trusted tax professional yet, you can go to biggerpockets.com/tax pros to find a trusted tax advisor in your area. I'm Hannah Escher. You can search my name on BiggerPockets. And if you found this video helpful, like and subscribe to the BiggerPockets Rookie channel for more videos just like this. I'll see you next time.